Welcome back to Wealth Wisdom, channel that explores psychology of success. Today, we will unravel the secrets of Warren Buffett investment strategies and philosophies. Warren Buffett, often hailed as the greatest investor of all time, possesses investment wisdom that has turned ordinary dollars into extraordinary wealth. Imagine investing $1,000 in his company, Berkshire Hathaway. When he embarked on this journey, today, that humble sum would have multiplied into a staggering $30 million. The allure of such returns may appear fantastical, but the key to Buffett's success lies in his profound understanding of investment principles that remain accessible to us all. Affectionately known as the Oracle of Omaha, Buffett's enduring success stems from his ability to identify exceptional companies and acquire them at fair valuations. His investment philosophy, heavily influenced by Benjamin Graham's value investing principles, can be distilled into memorable guidelines, such as Rule Number 1, never lose money, and if the business does well, the stock eventually follows. I am giving away free ebooks of Ultimate Guide to Investing by Warren Buffett. Please make sure you watch until the end to claim for the ebook. Here are 6 prominent rules from Warren Buffett for making money in the stock market. Number 1. Evaluating companies' intrinsic value. Our journey into Warren Buffett's investment wisdom begins with a foundational principle: evaluating a company's intrinsic value while steering clear of emotional decision-making. Emotions, in the world of investing, often lead to impulsive actions and clouded judgment, making them a formidable adversary for investors. Buffett succinctly captures this challenge with his statement, "The stock market is designed to transfer money from the active to the patient." This quote emphasizes the significance of patience and rationality in the investing arena. Let's delve further into this rule with a relatable example. Imagine a well-established tech company facing a temporary setback during the COVID-19 pandemic. Emotional investors might panic and rush to sell their shares, influenced by short-term market sentiment. However, a value investor, adhering to Buffett's philosophy, remains focused on the intrinsic value of the company. This astute investor recognizes that the company's intrinsic worth remains intact despite the temporary setback. Rather than succumbing to emotional impulses, they seize the opportunity to acquire shares at a discounted price. This decision is grounded in the belief that the market's emotional swings will eventually correct themselves, restoring the stock's value. Buffett's wisdom reminds us that emotions can be a hindrance in the investment journey. While it's natural to react emotionally to market fluctuations, the key is to rise above these impulses. By prioritizing intrinsic value assessment and maintaining a patient, long-term perspective, investors can navigate the market with clarity and rationality, ultimately aiming to maximize value and minimize emotional turbulence. Number 2. Purchase at a fair price. Let's delve deeper into the second cardinal rule of Warren Buffett's investment philosophy: the pursuit of quality companies at a fair price. This principle underscores the significance of focusing on the intrinsic value of a business rather than blindly chasing the allure of deeply discounted stocks. As Buffett succinctly put it, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The pursuit of outstanding companies contrasts this with an investor who adheres to Buffett's counsel and focuses on acquiring shares of truly outstanding companies, even if they are priced at what might be considered a fair valuation. These businesses often possess robust competitive advantages, sustainable growth prospects, and resilient operations. Let's look at an illustrative example from the technology sector. In 2007, Apple Incorporated was perceived by many as an exceptional company with innovative products but was trading at a valuation that some deemed fair. Buffett's principle would guide an investor to recognize the intrinsic value of Apple's brand, technology ecosystem, and growth potential. Over time, this decision to invest in an extraordinary company at a fair price paid off handsomely, as Apple became one of the world's most valuable and profitable companies. In essence, this rule serves as a reminder that, in the long run, quality prevails. Quality companies, with their enduring competitive advantages and resilience to market fluctuations, often outperform their peers. While chasing bargains may provide short-term excitement, Buffett's sage advice encourages us to adopt a more enduring perspective, seeking investments that stand the test of time and reward patient shareholders. Number 3. Never invest in what you don't understand. Warren Buffett often emphasizes on the importance of avoiding investments in businesses that are not thoroughly understood. This principle places a premium on informed decision-making, stressing the necessity of having a clear understanding of a company's long-term prospects and economic fundamentals. To illustrate this rule, let's consider a scenario involving two different investors. In this case, one investor is enticed by the prospect of quick gains and decides to invest in a highly specialized and intricate sector of the biotechnology industry. However, they lack the expertise and comprehension needed to navigate this complex field. On the contrary, the second investor heeds Buffett's valuable advice. They approach investments with diligent research and a commitment to comprehending the businesses they choose to invest in. Reflect on the consequences of the dot-com bubble in the late 1990s and early 2000s. Between 1995 and its peak in March 2000, investments in the Nasdaq Composite Stock Market Index rose 800%, only to fall 78% from its peak by October 2002, giving up all its gains during the bubble. Many investors were drawn into technology companies with little understanding of their underlying operations and financials. When the bubble burst, these investors suffered significant losses. In contrast, those who adhered to Buffett's rule by investing in businesses they truly understood were less susceptible to such market volatility. This illustration underscores a crucial lesson: investing in what you comprehend is a prudent strategy that mitigates the risk of making uninformed decisions. By following this guideline, investors can steer clear of investments that are beyond their expertise, safeguarding their capital and enhancing their prospects for successful and well-informed investment endeavors. Number 4. Do not miss big opportunities. The fourth rule in Warren Buffett's playbook, "Don't miss big opportunities," draws wisdom from his own experiences and serves as a reminder of the importance of recognizing and seizing significant investment prospects. Buffett himself has admitted to regretting opportunities he failed to capitalize on when he had both the knowledge and chance to do so. Buffett's remorse underscores the principle that opportunities in the world of investing do not present themselves frequently, and when they do, they often come in the form of rare and exceptional events. As he aptly puts it, when it rains gold, put out the bucket, not the thimble. Consider an investor who identifies a pioneering technology company in its early stages but hesitates to invest due to perceived risks. Fast forward several years, and this technology becomes a transformative force, revolutionizing entire industries. Unfortunately, the hesitant investor watches with remorse as others reap substantial rewards from their early investments. Conversely, an astute and proactive investor recognizes the potential of such opportunities, even if they come with an element of risk. These investors understand that, in the long run, bold actions taken in the face of promising opportunities often yield significant returns. This principle highlights the importance of decisiveness and a forward-thinking approach when evaluating potential investments. It serves as a valuable lesson that by diligently assessing and seizing opportunities that align with their investment objectives, individuals can position themselves for long-term financial success. Number 5. Don't influence by price fluctuations. The fifth rule in Warren Buffett's arsenal of investment wisdom emphasizes the importance of not making hasty decisions to sell shares solely in response to price fluctuations. Unless there are substantial issues with a company's management or an urgent need for capital, it is often wise to maintain ownership of good companies, even when confronted with the inevitable ups and downs of the market. Buffett's principle here underscores his characteristic long-term perspective, encapsulated in the mantra, "Our favorite holding period is forever." This philosophy challenges the common inclination to react impulsively to short-term market volatility. Consider an investor confronted with a market downturn, where share prices of fundamentally strong companies experience a temporary decline. An investor who succumbs to panic may hastily sell their shares, potentially missing out on the company's subsequent recovery and future growth potential. In contrast, a disciplined and resolute investor who adheres to this rule exercises patience and restraint. They understand that market fluctuations are a natural part of investing and do not necessarily reflect a company's intrinsic value or long-term prospects. By holding on to their investments through market turbulence, these steadfast investors position themselves to benefit from the eventual rebound and potential for substantial future gains. Number 6. Fearful when others are greedy and greedy when others are fearful. Our final rule encapsulates Warren Buffett's timeless advice: be fearful when others are greedy, and be greedy when others are fearful. This principle serves as a cornerstone of Buffett's investment philosophy, urging investors to maintain a contrarian mindset and seize opportunities when market sentiment reaches extremes. Imagine a scenario where the market experiences euphoria, with investors rushing to purchase a particular asset, driving its price to unsustainable levels. In the midst of this fervor, a prudent investor, influenced by Buffett's wisdom, resists the crowd's exuberance and refrains from overpaying for the asset. This contrarian approach aligns with Buffett's belief that excessive market enthusiasm often leads to inflated prices and, ultimately, disappointment. Buffett eloquently captured this sentiment when he remarked, "The stock market is a device for transferring money from the impatient to the patient." This quote underscores the importance of patience and a discerning approach to investing, especially during times of market exuberance. Conversely, when fear and uncertainty grip the market, causing share prices to plummet, the contrarian investor recognizes the potential for value amidst the panic. In stock market, 90% of the investors loses money. These are the people who panic and follow the majority to sell their share without understanding the value of the business. While others may be selling in haste, driven by fear, the astute investor capitalizes on the market's disarray, acquiring undervalued assets that often yield substantial returns once the market regains its composure. In essence, this rule encourages investors to go against the herd mentality and trust their own analysis and judgment. By maintaining a level-headed approach and avoiding the extremes of greed and fear, investors can position themselves to capitalize on market inefficiencies and build wealth steadily over time.